What if I told you there were 4 ETFs on the market that are absolutely crushing QQQ and the S&P 500, and one of these ETFs is up 25% year to date? In today's video, we're going to be talking about 4 great ETFs that could make you super rich, and they're beating QQQ and the S&P 500. Hey guys, my name is Steve, and I run the Frugal Expat website where we try to help people to save more and invest better. If you like this content, make sure to smash that like button and subscribe. Alright, let's get to it. Now in today's video, we're talking about 4 great ETFs that are going to make you super rich, and these aren't just your grandfather's boring old index funds with everything in it. These are some of the best ones out there that are outperforming the S&P 500 and even QQQ. Now before we jump into this video, let's talk a little bit about some strategy. Now the S&P 500 is one of the best indexes on the market. I mean, it tracks the market, and for the last 100 years it's been doing about 10% annually, so that is amazing news to you. And QQQ is one of the best growth ETFs out there. It's been trucking along since 1999, and it's had its ups and downs, but it's one of the best growth ETFs that you could add to your portfolio. Now, the reason we're talking about these 2 indexes is because they're some of the best ones. VOO tracks the S&P 500, is one of the largest ETFs on the market. QQQ tracks the Nasdaq 100 and is one of the largest growth ETFs on the market. But today we're going to be talking about something different. We're talking about 4 ETFs that have different factors and sectors that they are tracking. Now, these aren't just a fad like ARKK that was doing really well for 1 year and then crashed and burned. These are ones that have been doing pretty well over the long term. Now they're going to be tracking maybe some tech, semiconductors, some momentum, and have a little bit more factor investing within these. And so that's what we're going to be talking about, and they have been showing that they're doing pretty well over the long term. That's why I like these ETFs, and that's why we're talking about them. All right, let's get to our first ETF. Now, the first ETF is going to be SPMO, which is the Momentum Factor ETF by Invesco. Now, this ETF has been crushing it. In the last 5 years, it's been doing so much better than QQQ, and in the last year to date, it has been doing so much better. It's almost up about 25% year to date, while QQQ is doing about 13.7% year to date. So that means it is doing so much better. And why? It's because it tracks a momentum factor. Now, SPMO doesn't just track an S&P 500 index, it creates a portfolio of the top 100 momentum tracked companies on the S&P 500. So if Apple is soaring, it's going to add Apple. If JP Morgan is soaring, well, it's going to add JP Morgan. So it does a rebalance twice a year in March and September to track the 6 months and 12 months of a momentum swing for these companies. So if the company is going up for the next 6 and 12 months, it's going to add it to portfolio. Now that just means it's going to have high turnover, about 72%, but it is tracking the momentum factor. So that means if you have some FOMO and you want to kind of grab some of these stocks, well, SPMO is going to have those. Now, some of these top positions are Amazon, Nvidia, Meta, Berkshire Hathaway, Tesla. Have you noticed a pattern right there? A lot of these have been soaring in the recent years because of AI, and it's because it's got a lot of momentum. And so that's good news to you. So if you're looking for something that could make you super rich, well, SPMO is an ETF that could do it for you. Now, the couple differences between SPMO and QQQ would be kind of the costs. SPMO has an expense ratio of 0.13%, while QQQ has an expense ratio of 0.20%. And so it's a little bit cheaper. And if you took a look at some academics from UCLA created kind of a research about momentum, and they showed that during winning periods of the stock market, momentum factor ETFs could do about 1% better than the total market. So that's amazing news. It's going to beat the S&P 500, and it's also beating QQQ. Our next ETF is going to be VGT, which is the Vanguard Information Technology ETF. Now, this is a tech titan. I mean, we're talking about one of the best tech ETFs on the market. Now, QQQ has about 52 to 54% of its portfolio inside tech, while VGT has 100%. And we can see that with some of the holdings and some of the performance performance wise. Now, if tech is booming, VGT is booming more than QQQ. And VGT's got about 321 different holdings. QQQ's got about 100 different holdings. VGT's got an expense ratio of 0.09% versus QQQ being 0.20%. So there's a difference in expense ratios. So let's see about the performance wise. Which one reigns in the best? Over the past 10 years, VGT has been reigning better on performance alone. It has an annualized return of about 21.93%, while QQQ has done about 18.95%. So that's almost a 3% swing between the two. And if you like compounding, I mean, I would rather have a 3% more than less when it's compounding interest. So that's huge when you're growing your money. So that's why VGT is winning on performance, it's winning on cost, and it's winning on diversification. So when we're looking at something that's going to crush the S&P 500 and QQQ, VGT is one of those best ETFs to kind of buy and hold for that purpose. Our next ETF is going to be SMH. Now, SMH is a Van Eck semiconductor ETF. So if you think about semiconductors and you don't know what those are, those tiny little chips in our devices, like in our phones, our computers, our game systems, these chips power everything together. When we saw that there was a chip shortage, you saw prices go up because cars need chips. Everybody needs chips. One of the best chip companies in the world is Taiwan Semiconductors, and SMH has Taiwan Semiconductors within that portfolio. I mean, you think about other chip companies. I mean, you got Samsung, you got Micron, you got so many great chip companies, AMD, and these chip companies are producing more and more. And with this AI boom, you're seeing a huge surgence in these companies getting really price appreciation and growing and growing and growing. So having SMH a part of your portfolio, or having SMH to kind of push you towards getting more and more rich, is a good move. I mean, if you believe in AI, if you believe in companies creating and using more and more chips, well, you might as well have a good semiconductor ETF. Now, numbers don't lie. Performance is something we have to think about. Now, our performance with SMH, you're going to be getting around 24% for year to date, but on the 10-year average, it's doing about 29%, averaging every single year for the last 10 years. That is amazing news when we're looking at an ETF to grow our wealth. This is probably the best performing ETF on this list, but it's also just, well, one that's a little bit more concentrated in about 25 to 26 different stocks and companies, and so that could be a little bit risky. Now, with everything, with every reward, you also get those risks. I mean, if the AI boom kind of slows down, or even chips kind of slow down, well, then you're gonna see this money kind of drop. But you also had that reward. I mean, 29% the last 10 years, that's just great news. So think about that. If you want to invest and grow your money, SMH is a great place to kind of outperform QQQ and outperform the S&P 500. Now, with this expense ratio is sitting at about 0.35%, it's one of the more expensive ETFs on this list, but it's also got a huge return. With this, you have holdings like Nvidia, you have Taiwan Semiconductors, Broadcom, and ASML, and these are some of the great chip companies that you could have in your portfolio. Now, some of the risk associated with SMH is going to be some drawdowns and some upkeep. So there's going to be a little bit more volatility. When people talk about chips, there's going to be ups and downs with the market, and that could be something that maybe you can stomach. But with every good risk, there is a huge reward. So there could be massive drawdowns, but there could be also skyrocketing up in the air. That's where you get this huge, great performance over the last 10 years. All right, let's get on to our next ETF. Our next ETF is going to be IYW, which is the iShares Technology ETF. Now, this ETF tracks the Russell 1000 index, and it takes the best 150 companies out of the Russell 1000 index and puts it in its portfolio. Now, the difference between IYW and VGT is IYW doesn't concentrate on those mega cap companies like the Nvidias, the Apples, and the Microsofts. IYW looks at some of those mid caps and small cap tech companies that are coming through out the ranks, and it's got a great performance to kind of show you guys that, you know, value does kind of outperform some of these large cap companies. And we can see this in its performance alone. In the last 10 years, we can see see that IYW has done about 22.25% average, while VGT has done about 21.89%. So it's winning right there. Now IYW does have a bigger expense ratio of 0.39%, which means it costs about $39 for every $10,000 invested. But if you really get hung up on that when you're getting an ETF that is outperforming some of the best ones on this list, then that's just a little bit on you. I mean, I like VGT, but IYW is an interesting play right here. But that's just me looking at the numbers, looking at kind of the performance. And if I want a little bit more exposure to companies that are not those mega cap companies, IYW could be an ETF that you could buy and hold. Now let's talk about risk. Now these are not money printing ETFs. Now they have done really well in the last 10, 15 years. That's great news to you. But will it do well in the next 10 to 15 years? Well, that's a great question. I do not know the future, and maybe you do not know it as well. But if we're looking at it, if the tech market does crash, 3 of these 4 will also crash as well. If momentum crashes, well, that will crash as well. So we have to think about this. We have to make a well-diversified portfolio. Maybe you do have an S&P 500 ETF. That's great, like a VOO or an SPY. And if you wanted to add some more exposure to some growth sectors, you can have QQQ, or you can throw in a VGT, an SMH, maybe a Momentum, or even IYW. These other ETFs could help you build a well-diversified portfolio and create some more growth within it. So if you have a core with an S&P 500 ETF, you can add a little bit of growth and a little bit of sector, and you can add just a little bit more momentum and growth within your portfolio. And if those crashes happen, well, you can throw in some more money into them and let it rise after that. So that's just a little bit of risk to also think about. Can these 4 ETFs bypass and beat QQQ in the S&P 500? Well, the evidence is kind of telling right now. Right now, SPMO is beating QQQ. Right now, in the long term, we have seen VGT, IYW, and SMH doing so much better than QQQ. So if you want to become super rich, if you want to add some of these ETFs to your portfolio, remember the risk, remember the rewards, remember the opportunities you could be having. So will these make you super rich? Yes. Could these have a huge dip and downfall? Yes. But that's part of investing. Investing is risky. Not investing is also risky. So these are just some things to think about. Now, here's a little bit of my take. If you believe in technology and you believe in the growth of AI and believe in semiconductors, then you should add one of these ETFs to your portfolio. That is what I'm going to be doing. I already have SMH and VGT. Those are just ETFs that I'm going to continue to buy and hold and watch them grow my portfolio. So now let me know in the comments, do you own any of these ETFs? Do you own an ETF that I should be talking about that you think is a great growth ETF? Let me know in the comments, and I'll see you in our next video.